On the surface, it almost feels kind of obvious, doesn't it? Big companies getting bigger, the rich seem to get richer, vital resources feeling like they're owned by fewer and fewer people. It's in the air, right? We sense it.
Yeah, it is. But what's truly fascinating, I think, is when you dig into the numbers and see just how concentrated things have actually become. The scale is, well, it's quite striking. For instance, the material suggests private equity now controls a really significant chunk, maybe as much as 20% of the entire U.S. economy.
20%. Wow.
Yeah. And then look at the big public companies, the ones listed on the stock market. The top index funds, they own somewhere between 20 and 30% of all of them. It's even pointed out that, less savory things like fraud are apparently following the same pattern, getting bigger, more centralized.
Okay, so it's not just a vague feeling. The numbers back it up, but what's driving it?
Hmm.
And more importantly, what are the real world consequences for us?
Well, there seem to be a couple of big drivers mentioned. One is that classic idea,
Mm,
economies of scale.
yeah.
It just gets cheaper to do things bigger, so businesses are incentivized to grow, consolidate, get those efficiencies.
Right. Bigger is cheaper sometimes.
Exactly. And the other major factor, it's about how the financial system reacted to the whole too big to fail problem after past crises. The policies meant to stop collapses have, kind of ironically perhaps, allowed some of these huge entities to get even larger. So now, arguably, they really are too big to fail.
So the fix might have made the problem bigger in some ways. Okay, let's bring this down to earth. How does this concentration actually, show up in things we deal with every day, like resources?
Yeah, great question. We see it very clearly in areas like housing and water. The information points to these large investment companies actively buying up single-family homes.
Not just apartment blocks, but actual houses.
Houses, yeah. And the scale is significant. Like one example mentioned was a firm buying over 1,500 homes in just one quarter, paid something like $656 million. And there's this interesting angle,
Mm.
a suggestion that maybe tax dollars, through certain policies or structures, might even be indirectly subsidizing this buying spree.
Tax dollars helping firms buy up houses.
Okay,
What about water?
water's another one. As water becomes scarcer, Wall Street firms are apparently seeing it as a profit opportunity. There's a specific firm mentioned, Water Asset Management, focused just on that. And if you look at individual wealth right at the very top,
Mm.
the concentration is just staggering. We recently saw the first person cross the $400 billion net worth mark. Record-breaking stuff.
Right. And you mentioned private equity, or PE, earlier. The material really highlights it as a major force. It's almost painted as the new, I don't know, the new boogeyman of finance, like hedge funds used to be, maybe.
Yeah, maybe. But PE, well, at its core, it's actually pretty simple. It just means investing in businesses or assets that aren't, listed on public stock exchanges. Like if you invest in your neighbor's local shop, technically that's a form of private equity.
Okay. Like the farmer's market stall example. Got it.
Exactly. You're investing directly, not buying shares on the NASDAQ.
Mm.
But what's really remarkable is how it's just exploded.
Hmm.
In the last, say, 15 years or so, PE has gone from being this sort of niche thing for wealthy families to, well, one of the biggest asset holders on the planet. Getting precise numbers is tough because it's private, but estimates put the capital they control in the trillions. One recent figure was over $13 trillion, probably higher now.
13 trillion, that's huge.
It is. And it raises that key question. Is PE actually creating value in the companies it buys, or is it mainly just extracting it? And why did it get so big so fast? The material suggests it wasn't necessarily because PE returns were just so amazing compared to everything else. It seems to be more a consequence of the financial system itself becoming so concentrated, funneling capital into these private channels.
Okay, this is where it gets really interesting for me. The flip side of all this private market growth, what's happening to the public market, the stock market we hear about every day. You're saying while the economy's grown massively since the 90s, the number of companies listed publicly has actually dropped by almost half.
Yeah, pretty much halved, while the economy roughly tripled. It's a stark contrast. And there are two main reasons given for why fewer companies are going public. First, consolidation. Big companies are just buying up smaller ones at record rates. Fewer independent companies left to go public.
Makes sense. Eat or be eaten.
Right. And second, and this is really key, companies often just don't need to go public to do an IPO to get money anymore.
An IPO, that's the initial public offering, right? When a private company first sells shares to everyone.
Exactly. That used to be the main way to access big capital from the public. But think about that wealth concentration we mentioned. If the wealthiest 10% own something like 93% of all the stocks already.
93%. Wow.
Yeah. It means most of the investment capital is already held by people or institutions rich enough to invest in private equity directly anyway. So why would a company go through all the hassle, the regulations, the expense of being public, just to access the remaining 90% of people who only own 7% of the market combined?
The cost benefit doesn't stack up anymore for them.
Exactly. Especially when a lot of that 93% is held in things like retirement funds, which are managed by big institutions. Institutions that can and do invest in private equity too. It sort of reinforces the whole cycle.
So, okay, maybe having fewer tickers to scroll through on Robinhood isn't the end of the world for everyone, but the information seems pretty clear. This trend, which has really accelerated just in the last 15 years or so, it's creating real problems, problems that actually cost you.
Absolutely. These aren't abstract issues. They hit your wallet, your job prospects, your community. Let's walk through some of them. First up, micromonopolies.
Micro-monopolies, not the huge global ones.
No, something maybe less obvious but really common. Think local. The example given is youth sports leagues. Investment firms are apparently buying up, say, all the competitive soccer clubs or gymnastics centers in one town or region, creating a local monopoly.
Seriously, for kids' sports.
Yeah, it's apparently a multi-billion-dollar industry now, and costs are going up because of this consolidation. It removes choice for parents. And while this kind of thing is often, technically anti-competitive, maybe not even legal, it just doesn't get enforced much. Regulatory bodies like the FTC are mentioned as being swamped, understaffed. They can't possibly track thousands of these local roll-ups. So it changes where you spend your money, often leaving you with no other option.
Right, affecting things right in your neighborhood. Okay, what's next?
Next is a big one. Lack of transparency. Public companies, they have to report everything. Finances, performance, risks. It's all out there. But when businesses are owned privately, especially by layers of PE firms or holding companies, well, good luck figuring out how they're really doing or what decisions are being made.
So it's harder to see what's going on under the hood.
Much harder. Think about your pension fund. If it invests in private equity, it can be almost impossible for you, the actual beneficiary, to see how your retirement money is being used down the line. There's so many layers in between. And this transparency issue also connects to those huge index funds we talked about, Vanguard, BlackRock, State Street.
How so?
Well, the way they often invest, it's passive.
Yeah.
They buy stocks, mainly because a company is big and part of an index, like the S&P 500. Not necessarily because they've deeply analyzed if the company's a good value.
So they just buy based on size.
Largely, yeah, based on index weighting.
Yeah.
This makes that natural process of price discovery. The market figuring out what something's really worth harder. It can kind of inflate the value of already big companies just because they're big.
And gives those fund managers huge power too, right?
Enormous power. Because they hold so many shares, their votes, in shareholder meetings, on-board decisions, it's incredibly influential. Even with things like ESG funds focused on environmental, social, governance factors, their sheer scale gives them a huge say. Okay, problem 3, corporate debt. This ties back to PE quite a bit. A common strategy is the leveraged buyout, the LBO. Basically, the PE firm buys a company but uses borrowed money to do it. And crucially, they often structure it so the company they just bought takes on all that debt.
Wait, the company itself gets loaded with debt?
That's often how it works.
Sure.
The PE firm might use the loan money to pay itself back quickly, maybe pay themselves dividends or fees, leaving the company struggling under this huge debt load.
And then?
And then often comes cost cutting. Layoffs, reduced investment, selling off assets, whatever it takes to service that debt they were saddled with. This LBO process is a major contributor to the record levels of corporate debt we see in the U.S. Levels that have really only been higher during specific crises like right after the financial crisis or during the initial wave of pandemic support loans.
So PE, index funds, low interest rates, maybe not enough regulation. It all kind of feeds into this concentration cycle.
That's the picture painted, yes. It all accelerates the trend.
Okay, what else? You mentioned impacts on earning money too.
Right. Problem 4. It can become harder to find competitive job opportunities. Think about a skilled tradesperson, like the plumber example used. If one big company buys up all the local plumbing businesses in your area, where's your negotiating power?
There's no one else to go work for, really.
Exactly. You lose leverage because there's no real competition bidding for your skills anymore. It can suppress wages or limit career progression.
That makes sense. And this leads to the next point, right? Difficulty starting new businesses.
Yes, problem 5. It's described almost as a stagnant pool of American entrepreneurship. Starting something new gets harder. There's an example of a healthcare entrepreneur, Lillian Salo, who developed a potentially safer syringe. But she apparently faced massive hurdles because the existing consolidated supply chains, manufacturers, distributors were reluctant to work with her.
Why? Because she was a potential competitor.
That's the implication. Even if her product was better, it's that anti-competitive behavior again, often flying under the radar of enforcement. And this is especially tough in tech, particularly scalable tech.
Silicon Valley stuff.
Yeah. Early investors, venture capitalists, they often prioritize the exit strategy, meaning who is going to buy this startup later? The most likely buyers, either one of the existing tech giants or maybe a PE firm.
So you build to be bought?
Increasingly, yes. Funding often flows to companies that look like good acquisition targets, ones that can scale quickly within the existing ecosystem. This might shift focus away from solving truly fundamental problems towards things like, say, optimizing user engagement on platforms that already dominate. One VC even called it that stagnant pool. Raising capital if you don't fit that mold is incredibly hard. Programs like Y Combinator are hyper-competitive, and often having the right connections is key to building something specifically designed to be acquired.
And this affects the tech workers too, right? The tech bros, as sometimes mentioned. That cycle of maybe a life-changing payout if your company gets bought, or being part of those record layoffs when consolidation happens or priorities shift. A very volatile situation driven by these larger trends. Okay, so let's try and wrap this deep dive up. We've covered quite a bit. The sheer scale of this economic concentration, how it's hitting resources like housing and water, the huge role of private equity and index funds, the shrinking public market, and then these real problems: transparency, jobs, starting new businesses.
Yeah, and if we connect this back to the bigger picture for you, the listener,
Mm,
it's pretty clear. This trend, which has really, as we said, gathered steam in the last 15 years or so, isn't just some abstract economic theory. It has real, tangible impacts on your everyday life. It influences where you spend your money, the choices you have, your ability to earn, your job security, even how your retirement savings are being put to work, often quite opaquely.
yeah, definitely a lot to chew on there. So maybe a final thought to leave everyone with. Given everything we've talked about, how hard it seems to be to start new, truly independent businesses, how existing ones get rolled up, how capital is so concentrated, where do the next big disruptive ideas or real competitive challenges actually come from in the future? And maybe how can individuals play a part in fostering that kind of innovation outside these giant concentrated structures? Something to think about.